Hello there and welcome to this week's casual educational video that is all about the 5 most common investing mistakes. Now, this list is not one that is based on my personal experience. It is not one that is based on my imagination. I didn't come up with it. It is based on numerous surveys that have been performed in the past. I went through them and basically this is the outcome. Now, my addition are the safeguards that I have in place that help me avoid these mistakes. As human beings, we are being exposed to all kinds of risks, and in most cases, we are being given some safeguards that help us prevent those risks or avoid them. I'll give you an example. From a very young age, we are being taught that crossing a street can be dangerous. There are vehicles out there, which is basically the risk. And in order to avoid that, the safeguard is take a look left and right, or right and left, of course, depending on which country you live in, before you make sure that before you cross the street, but to make sure that there are no vehicles in the way. Now, in the world of investing, there are a lot of articles out there, there's a lot of information, but safeguards is something that is not that much discussed. So hopefully in this video, going through the mistakes is not going to be an activity on its own. We're going to take a look at the safeguards and hopefully that will be useful to some of you. So let's take a look at the first most common mistakes, and that is buying or selling stocks because of someone's opinion, whether that is coming from Reddit in the form of a certain post, or Twitter in the form of tweet, or YouTube in the form of video. All of these platforms could add value, but also could destroy value. And in today's world, basically, we have overflow of information because if our environment is set up such that we are surrounded with posts and tweets and videos, there is no doubt that we will have a lot of opinions around us from others. That doesn't mean that all of those opinions are bad, but listening to each and every one of those could pose a danger if we act on all of those. I'll give you an example. Oftentimes I stumble upon posts of someone who has invested, who bought stocks in a certain company, and the post goes something like this. I've bought shares in this company and it's down 20%. Should I still hold the shares or should I sell? Now, anytime that I read that kind of a question, it's obvious that that person doesn't know the value of the holding, which is the outcome of basically buying or selling stocks because of someone's opinion. And the solution is not asking again for the next action. The safeguard is doing your own diligence to make sure that you are aware of what's in your portfolio. And this is something that I try to do in a bit of a different way, not only, of course, to do my own due diligence, but oftentimes I also stumble upon articles and posts that seem very convincing, or videos, and it seems as this is really the next big thing. This is something that I have to invest in. But it could be that that particular post or video doesn't have all the information. So what I do in that case is I take the ticker, I note it down, and I come back to it in a week, a month from now, and I do the analysis on my own without any bias from anyone else. At least that's what works for me, but of course that takes time. But it is at least my way to avoid investing into something because someone said it would be a good idea. And whether that is a safeguard that works for you or not, yeah, of course you have to decide for that. Now let's take a look at the second mistake, and that is trying to time the market. I'm going to invest right after the next crash, and then I'm going to sell at the top. Now that's also something that sounds very good. In reality, that's very difficult, and I don't know anybody who is successful that has timed the market for a long period of time. And I have here an article that is published March 28, 2016. Rich Dad author Robert Kiyosaki says that 2016 market collapse, which never happened, he foresaw in 2002 is coming. This is the title of an article. Now, let me be clear. I have no respect for anybody who makes such claims, pretending that they know exactly when the next crash is coming. And I'm not referring only to Robert. I'm referring also to all the content creators out there who use fear with the purpose of getting more clicks on their thumbnail, on their videos, on their posts, or whatever that may be, because I don't think that's fair. Equally, the opposite is true. I have no respect for those who are trying to sell you the next opportunity. You have to invest in this. It's going to 10x in the next 2 years, 5 years, whatever. Let's face it, nobody knows that. So my safeguard for that is, first of all, I don't click on those articles or videos, and I just completely ignore such information. Unfortunately, all of that is legal, and there's no punishment for sharing such misinformation. And we're being surrounded with a lot of that on a daily basis. So this is at least something that works for me. And again, I have no respect for anybody who is engaging in such misinformation. Now, number 3 is overestimating the future growth and our profitability. And this is what I sometimes call wishful thinking. You like a company so much that you just see a very bright future, and at some point that forecast is even not feasible. And I have been guilty of this probably the most out of the 5 mistakes. But my safeguard that I have is applying margin of safety. And I'll give you an example. When I valued Tesla, the fair value per share that I got based on my assumptions was about $190 a share. And my average price, or the average price that I paid for Tesla share per share, is 150. So on purpose, I wasn't buying at around the fair value. I waited that it goes a little bit below because I could be overestimating the future growth or the profitability of the company. At least this is what, again, works for me. But make sure to challenge your assumptions. That is incredibly important. Number 4 is confirmation bias, or the tendency to search for, interpret, favor, and recall information that confirms or supports your beliefs or values. And this is oftentimes what happens when somebody already has a position in a company, has committed capital, and really wants that company to succeed and the share price to go up and up and now. And the problem with that is you have to stop for a second, reflect, and take a look at all the facts out there. Confirmation bias is basically where you don't see all the facts out there. You decide to only see the facts that are in line with your beliefs, regardless of the company. And this is, I've seen this in many posts as well, when someone has an investment thesis and has a position in certain company, and then there's a comment, hey, but have you looked at this? There's something that this is something important. It has impact on the fundamentals of the company. And then the response is, well, yes, but have you seen this? This is exactly what's matching with my belief. And the safeguard that I have here is just don't be arrogant. Nobody knows everything. And if I'm faced with a new piece of information that has impact on the valuation of a certain company, I adjust my assumptions. If that leads to the outcome that I should sell my shares in that company, that's it. Being emotionally attached to owning shares in a certain company and deciding, well, whether that's conscious or subconscious, to ignore the facts that are not matching with the beliefs can be quite dangerous in the long run. So at least for me, trying not to be arrogant. I'm aware that I don't know everything, and every time there's a new piece of information, I'm open to the fact that it might change my investing decision. And the last one is failing to monitor the investments. I think this is the easiest one to make, but also the easiest one to solve, as all you need to do is follow up on the latest information that are published by the company directly. So, and this is important to note, published from the company directly, not published on Reddit or on Twitter because someone said, hey, maybe this is something that will happen to the company. Pure speculation. It is important to make the distinction. And basically, these are the 5 mistakes that I think are most common. At least that was the outcome based on the surveys. And I think that is, it's a fair list. And it's up to you to decide whether to use these safeguards, whether to come up with your own. But if you have some safeguards that you think could benefit me, but also other viewers of this video, please share them in the comment section below. As always, thank you for following this video until the very end, and I'll see you in the next one.